Hello, accounting kids. Mrs. Martin here. Just going to finish off with our last lesson for Chapter 11, and this is for accounting for the declaration and payment of a dividend. So what we're going to learn about in this section is the relationship between retained earnings and dividends, and then we're going to learn how to account for the declaration and payment of dividends. So back in part 1 of the book, we learned that a sole proprietor, so someone who owns a business, could withdraw cash from the company by recording the transaction in the owner's drawing account. So they took money out and we recorded that in the drawing account. In this lesson, though, we're going to have to learn how cash is distributed to owners because a corporation does not have a drawing account for each stockholder. So it's quite a bit different. So that's something we're also going to learn about in this lesson. So here is stockholders' equity accounts used by a corporation. So the owner's equity accounts for a corporation are listed under a major chart of accounts division, usually titled the stockholders' equity. So you can see here that the stockholders' equity is the 3,000 account, and then the individual accounts are numbered and titled differently. So most corporations have many stockholders, so it is not practical to have a separate owner's equity account for each and every stockholders. So that's why they just have this account called capital stock. And that's just a single owner's equity account essentially that's used for the investments of all the owners. Net income increases a corporation's total stockholders' equity, so some income may be retained by a corporation for business expansion. So maybe they're not giving all of the net income back to its stockholders. Maybe they want to grow their business, so they're going to keep some of that. I want to just take a step back and talk about net income. So I think you guys all understand net income, but again, net income is any revenue over expenses. So if we had more revenue than we had expenses, that's a net income. If we had more expenses than we did revenue, that's a net loss. Okay, so I just wanted to step back and talk about that for a second. So let's talk about retained earnings and dividends because we need to understand what those are. So amount earned by a corporation and not yet distributed to its stockholders is called retained earnings. Retained earnings is the stockholders' equity account used to record a corporation's earnings. So some of the corporation's income may actually be given to stockholders as a return on their investment. So these people are investing in your company, so they want to make some money, right? They're not just giving you this money for nothing. So the earnings that are given to the stockholders, those are called dividends. And the corporation's dividend account, and I want to head back here and show that this dividends account here is a temporary account similar to a proprietorship's drawing account. So that drawing account we have to close out. So we also would have to close out this dividend account because each time the dividend is declared, the stockholders' equity account, dividends, is debited. And then at the end of each fiscal period, when we're closing that accounts, the balance in dividends is closed to go to retained earnings, right? Because retained earnings, as we talked about, is that money that we've earned that we have not distributed yet. So once it's distributed, we have to reduce retained earnings, right? So it's sitting in dividends is what we're paying out, and when we close the fiscal period, we need to make sure that affects retained earnings. So how do we declare a dividend? So we have, when you own your own business, let's say you have a sole proprietorship, you're the owner, right? You make the business decisions. But in a corporation, it's different. So a group of people elected by stockholders to govern a corporation are called the board of directors. So stockholders are the people who are investing in the company. They own shares in that company. They are investing in it. So they elect the board of directors. So dividends can be distributed to stockholders only by formal action of the corporation's board of directors. So they have to declare a dividend. So the next one says, an action by a board of directors to distribute corporate earnings to stockholders is called declaring a dividend. So dividends are normally declared on one date, and then they're usually paid at a later date. Not all corporations do declare dividends. They just have to the board of directors, it's their responsibility to consider how those dividends may impact the corporation, and then they need to see what the desire of the stockholders to receive the dividend is. So when a dividend is declared, though, the corporation is obligated to pay it. So they can't just declare it and then not actually pay it. So as you probably know, a dividend then is a liability, right? Because we're saying we're declaring this, but we're going to pay at a later date. So we need to set up this liability, right? That dividends payable account. So we know that our liabilities have a normal balance of credit. So we're going to set up this liability, and then when we do pay that, we'll debit it, okay? So when a dividend is declared, the corporation, again, is obligated to pay it, and the dividend is a liability that must be recorded in the corporation's accounts. So a dividend cannot exceed the balance of retained earnings. Like, we cannot pay our stockholders more than we have actually earned, right? We can't do that. So let's go to the next screen here, and let's just go through this scenario. So on December 15th, 3 Green's Board of Directors declared a quarterly dividend of 5 cents per share. Capital stock issued is 75,000 shares, so the total dividend is $3,750. So that this dividend was declared on December 15th, and the date of payment is January 15th. Again, memorandum number 43. All right, so how did we get this $3,750? So we have number of shares in our capital stock is 75,000, right? And we said we are going to pay a quarterly. So remember, quarterly is 4 times a year, so there's 3 months within that period of 5 cents. So we're just going to take simple math, take 75,000 times 5 cents. And that's going to equal $3,750. Okay, that's easy math. Now we got to figure out how this is going to hit our books. How is this going to affect our books? So what I talked about before is when we declare a dividend, we know that we're going to pay that as a later date. So we know we're going to have a payable. We know we're going to have that dividends payable. And anytime we're increasing a payable, we're going to credit, because the normal balance of a payable is credit. So we know that dividends payable is going to be credited. Okay, so what account is going to be debited? Well, the stockholder equity account is dividends, right? That's where we're paying that from. The stockholder equity account dividend increases by debit and has a normal balance. So let's just show the T account here. We're going to increase dividends, and we're going to increase dividends payable. All right, so now we'll show what that looks like in a T account. So we're going to have dividends, debit, dividends payable, credit, the date, the 15th, and again, it just told us that it was coming from that memorandum, and that's going into the general journal. Okay, so now we just declared dividends. That was before. We declared it, and now we're going to pay it. So now we're in January, and we're going to pay our dividends. So which journal do you think that this is going to affect? We're paying out dividends, okay? This actually can hit a special journal. What do you think that is? I know you're all saying cash payments right now, right? So 3 Green is going to issue 1 check for the amount of the total dividend to be paid. So most corporations will just make that check payable to a bank, and then that bank handles all the details of sending individual checks to individual stockholders. A lot of times the company doesn't do that, but they'll just send it and then have someone else take care of that for them. But we know that we're going to be paying money out. So we know, first of all, I always say take the easiest account that you know that's going to be affected. So if I'm paying money out, I know that cash is going to be affected, right? So I know that I'm going to have to credit cash for $3,750. I know I'm using cash, therefore I know that that can go in the cash payments journal. So when something cannot go in the cash payments journal or the purchases journal, you know that we have to use the general journal. But because this is the cash payment, we know we can use the cash payments journal. So here's what it looks like. So we paid cash for our quarterly dividend declared column. So we paid the $3,500. So Dividends payable, we had that payable set up and now it's time to pay it. So we're going to debit dividends payable to clear that out. And then, of course, we're going to credit cash because we are reducing the amount of cash we have because we're paying the money. So here's a shot of our cash payments journal and what it would look like. So January 15th, so we put a 15 there. The check number, that would be the check number that we use to pay the bank or whoever, whatever agent we're using. And we're debiting, and then we're crediting cash, right? And why are we doing debit in the general? Because we're not doing accounts payable or purchases, right? So we would just put it in the general account because it's going to hit dividends payable. All right, let's talk about what we know. So under what major chart of account divisions are owner's equity accounts for a corporation normally listed? Okay, so we talked about that. It's going to be in the stockholders' equity. Why is only one account maintained for the investment of all owners of a corporation? Why is only one account maintained for the investment of all owners of a corporation? So again, a lot of bigger corporations have many, many stockholders. You can be a stockholder and only own one share of that company. In this case, you would have gotten 5 cents, right? But there can be a lot. So it's really not practical to have separate account owner's equity accounts for each stockholders because that could get pretty, that require a lot of work to keep all of those separate. Which account does a corporation use to record earnings not yet distributed to stockholders? So remember we talked about the difference of two things. We talked about the difference of retained earnings and dividends. Okay? So this one is retained earnings because we haven't paid it out yet, and it's just the amount earned by a corporation and not yet distributed. How and when do net income and dividends impact permanent stockholder equity accounts? So at the end of the fiscal period, we have that temporary account, and then we are going to post that to retained earnings. So net income increases retained earnings and dividends reduce. So if we're paying out money, of course it's going to reduce our retained earnings because our retained earnings is our stockholders' equity, right? That's where we're showing how much money we have left. So if we had an income, it's going to increase that, right? It's going to increase the amount that we have. What action is required before a corporation can distribute income to its stockholders? Who has to make this decision and what has to be done? So the board of directors must declare a dividend. And when they declare that dividend, they must pay it. They're obligated to pay it. They can't back out. Even if something drastic happens in the market and they lose money, it was for that other quarter that they declared it, and they must pay it. All right. So I will go ahead and let me get out of here. I will go ahead and post this on Schoology, and if you can just finish on your own 11.3 and upload it. Hopefully you can get it to work, AJ. Upload it to the file just so to keep it everything there. It's just easier to organize, and then work on the application problem 11.3. I hope you guys had a great Easter. I was kind of sad. We didn't do too much and just kind of stayed home, and it was nice to spend time with family, but I would have liked to see my parents and everyone else, but that's okay. Hopefully everyone is healthy and maybe we can get back to school this year. Who knows? All right, guys, I'm going to stop talking now because it's late and I want to go to bed. So have a great week, and hopefully we can get together sometime this week to talk on Zoom. Bye.